Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, September 20th, 2022. I'm your host, Will Pauly, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Sitting here celebrating my mom's 100th birthday today up there in Ohio. She was
Nice. Well, what do you think about starting off with a look at what the markets are doing this past week with a look at the market letter?
Okay, we had a rough week in the market last week. The investors were kind of hit with sticker shock after we had the CPI, which is the consumer price index, and the PPI, which is the producer price index. Those reports came out and showed that inflation was a little bit stickier than hoped. Part of the problem was a lot of some investors were thinking that because gasoline prices had tumbled, that we would see a little. We probably would see peak inflation, and we could start to see maybe the Fed take the foot off the gas pedal a little bit, but that's not going to happen. At least not here today or tomorrow, probably. And we saw, year over year, I think the core CPI, which takes out food and energy prices, was up 6.3% year over year, and then up 0.6% for the month, and that was double what they were expecting on the core CPI. For the week, just in those 2 days alone, we had the Dow drop about 1,200 points, and NASDAQ was down about 5%. We got some mixed economic data on Thursday, which showed, some of the manufacturing stuff is still weak. We had a little bit of a tepid bounce on Wednesday. Maybe some people were hoping that maybe we would see even slower economic data on Thursday, but it was, like I say, it was mixed. That sent equities down again. But we did get some analysts out there saying that they hope that the Fed doesn't put the pedal to the metal for too long, because you go too far, you're going to cause a deeper recession. They're kind of hoping that he's maybe going to start to slow up here a little bit, so we can maybe have avoid a recession or just have a weak recession. I think that's pretty tough to do, to stop the train and have it end up just being a weak recession. I think you're going to see tomorrow. The only thing that's going to keep this thing from really having a dip tomorrow would probably be if he would come on and say, okay, we're going to sit here and let's just take a couple of months to see how these rate hikes are going to work out. But I don't think he's going to say that. They can't lose their credibility. They want to get the inflation on the run. So that's how we did. We came out also last week. We had an overnight warning from FedEx. That slammed stocks on Friday. I think FedEx is down about 20%. They're having problems with getting workers and getting stuff shipped out. I think every single sector was down last week. In fact, materials, industrials, communication services, REITs, and technology were actually all down more than 6%, which is that's a pretty big hit. And we had, as mentioned, yields moved higher in anticipation of this week's FOMC meeting announcement on rates. We're looking at about a 3/4 point hike. I think it's about 90-some% that we're going to get that. Some are thinking we still could get a 1 point, and then the other side, some of the people that are a little bit less bullish on the economy, they're looking for maybe a 0.5 point, but I think they're going to settle in at a 3/4 point, and we'll see that tomorrow. So the crude oil changes were a little changed during the week, but we are seeing the commodity prices nudge lower. A lot of that is because of the strength in the U.S. dollar. As the dollar goes higher, you'll see commodity prices come lower. The energy stuff with oil is a little bit different because of what's going on over in Ukraine. But in general, because of the stronger dollar, you're seeing the lumber prices and actually some of the natural gas and some of that other commodity things like that, copper and all, come down a little bit, which going out a little bit will help the inflation picture. But it's not going to help the wages and wage inflation, which they're trying to battle with. Technical condition of the market deteriorated last week. We were well down for the month. We've actually been at 2-month lows, I think, of the major averages. Technical indicators rolled over into negative territory. MACD is a short-term gauge. It's bearish. Momentum, gauged by the 14-day RSI, it's moving lower, and it's trading somewhere around the 30 level, which indicates we're still in a downtrend over the near term in here. We also we talk a lot about the secondary indexes. We see them lead the market higher and lower. Last week, the Dow Jones Transports and Semiconductor Index, they were two of the weakest indexes out there, which is another negative for the market here going forward. So, we broke through the week before. We started to have a little bit of a bounce. We were able to get above the 50 and 100-day moving average on some of the different indexes. We broke through those levels last week, and it looks like right now we're probably it looks, as I've been mentioning for quite a while here, that the June lows look in sight, and we'll have a little bit of we'll talk a little bit about whether I think those hold or not. But underlying breadth right now is not supportive of any kind of bounce. The NYSE and NASDAQ AD lines, advanced decline lines, are they lost some good ground last week. New 52-week lows are expanding, and we're having yesterday we had something like 42 new highs in the NASDAQ. We had 489 new lows on the NASDAQ yesterday. So expanding more and more, hitting more new lows on that. That's a bearish condition. Looking at it today, we're down about 500 points in the Dow, and again, with the NASDAQ's off about 475 new lows. New York has 362 new lows. So, nothing really looks good out there this time. We had a little bit of a bounce yesterday, but as we said in the comment, that I don't think that's going to stick. We had a little bit of an uptick in the number of bulls last week, as we were getting a little bit of a bounce. That'll probably just roll over and disappear again this week. But we talked a little bit last week, and I put it in the letter, as I said, where a lot of investors who look at some of these bounces and they think, I got to jump in there if the market starts to take off, because we're down so low. I want to make the easy money fast. And we talked about how bonds are becoming more attractive, and what we're going to see here is that when you're retired or you're older, if I can, especially with the fluctuations in the stock market here over the last couple of years, you basically have nothing to show for it. But with the bonds now, we can come in and maybe pick up 4 or 5% guaranteed over 2 years and get your money back. You're not going to pile all your money back into stocks like we've had over the last couple of years. So I don't think you're going to see these major indexes. No matter, even if the Fed's a little bit, a little softer than what they've been over the last week or two, I don't think you're going to just see this thing take a V recovery and head straight up. A lot of that, the demand in stocks is not going to be there like it was over the last couple of years when you had negative rates, basically, that kept you in stocks. So at this stage right now, we're look for the 3/4 point hike tomorrow. That's already baked into the market. It's pretty much going to be what Chairman Powell talks about it. Afterwards, I think he comes on about 2:30. They announce at 2:00. He comes on at 2:30, and he'll be talking. But he's going to have to sound tough. He can't come out here and act like they got everything under control, because they don't, and they know that. They don't want to try to surprise the market. I think they would like to see the market come down a little bit more. They've already said that they want to see the initial jobless claims tick up. They want to see the unemployment rate tick up a little bit, and that's going to be the only way you can do that is to get these rates up higher for longer.
All right. So we got a pretty strong bounce yesterday, and today we get another sell-off that erased it, and then some. Is this traders guessing the Fed's going to increase rates more than 0.75 points, or lower than 0.75 point? and trying to front run the Fed or something else. A rally seems contrary to what we expect from the Fed tomorrow.
Well, yeah, I actually got a couple emails last night and today. I was talking about resistance in bonds and the rates, which is one of the reasons why we had that bounce yesterday. And let's pull up some charts. Go to the charting package on there. But despite yields inching up and stuff like that, we had the equities grab some upward momentum, and the rate on the 2-year bill. The reason being, the 2-year rate got up right about 3.97, and stopped there, and it's stalled below 4%. And on the 10-year Treasury rate, which was down around, which had crossed above 3.5% back in June when we hit the lows, it got up to around 3.45, and it stalled there. And I think, I know, you have certain algorithms and you have certain some traders that they see this stall because they went, okay, well, it didn't go, it didn't break through to the resistance or support level there. We need to, we're gonna bounce it here, and that means that it held, and it was basically just a technical bounce that we got yesterday. And I said, you're probably going to see investors try to fade this thing. So, well, let's look at the at IEF on the charts. Okay, this is something I want you to, if you write this down, I think it'd be beneficial for you. This is an ETF that represents the 7 and 10-year T-bill.
I don't know what it just did. Sorry.
Okay, here we go. All right. Okay, so you can see this over here. As this goes down, this represents the bond. As this goes lower, that means that yields are going higher. Okay, and you can see over here, over here on the right-hand side, there's a very clear double bottom, which is a bullish pattern in any asset class. Okay, it comes back down here, boom, you hit the lows before, and now if it holds that, we're going to get a bounce up. However, today, back in June, it held that 3.5 area, and then we got that bounce off there. Well, today we crossed above that. That's one of the reasons why you're seeing the sell-off. So the people that thought, okay, well, 3.5 is going to top out there on the yield. Okay, let's buy it here. Okay, today we're up around 3.558, 3.59, something like that. So it didn't hold. Yesterday when it got to 3.49, it was unable to go above that. Traders came in and thought, okay, let's get a technical bounce, and they got it. That was wishful thinking as far as I'm concerned, because just because we couldn't nudge across there ahead of what the FOMC meeting was going to do. But anyway, that double bottom is what brought people in. As you can see right now, today, you can't see it on this chart, but today we broke below that level, below the June level, and why we're going down now to test the June lows. Okay, now put up for the 2-year T-bill, put up SHY. This is another ETF, and this is the 1 to 3-year T-bill. On this one, here you can see that over the right-hand side, you can see that it's broken below the June low. It gapped lower last week when we got the CPI number, then the PPI number. Now, I want you to these things can be used, just like any kind of chart, indicator, something like that, and people will look at these. And I want you to keep your eye on these, because especially on the 10-year now, especially on that IEF, when you see that thing break below the June low, that's 3.5%. Let's just say that the 10-year goes to 3.7 or something like that. That means that's going to pretty much tell you the stocks are going to go below that June lows, and they're going to go even lower. Now, like I said, the 2-year has already confirmed that it's already gone below the June lows that are put in, and that means that we're going to probably move here lower over the short term at least. Now, you can also when I looked at some of these, you can't really tell on this chart, but I think the next support on this on the SHY is going to be 81.28. I know that's pretty precise, but that's about where the 100-month moving average would fall in if you could look at a monthly chart. And then the next big support is going to be 79.50. and that goes all the way back to where it was in 2018. But that's you can see where we pretty much held around that 79.50 area for about 6 months back in 2018, and that's where you have some real big support at that level. I'm not sure what that would put the rate at. I didn't have time to do my math. I would think it would be somewhere on the 2 year, somewhere around 4.25 to 4.50. Okay, now the 10-year, where the IEF broke below the 100-month moving average here yesterday, and the next support on that. Go ahead and put the IEF up again. Now, even though you can take this back several years, take it to the left as far as you can, just to see. I don't know if this is going to show it or not. Okay, well, we broke the, but anyway, the IEF, its next support is 95, and that's from late 2018. I'm not sure exactly what the exact yield would be at that number, but when you see this thing here, the IEF get down to around 95. If you keep checking that, and you're wondering if the stock market has put in a bottom, when it gets to that number, if you can see the IEF bounce off of that, if that means as far as what traders are looking at, that means that okay, maybe the yields have topped out. That would be a sign that maybe we're going to get a market bounce, and the traders start to see that, and you watch the VIX start to come in, and that's telling you that the traders are thinking, okay, that this could be it. Maybe we're going to see the Fed start to reduce their actions a little bit, come off the gas a little bit, and also when the SHY, you want to see if that thing gets down here to around 79.50. That would be big support. And that's, like I said, it's going to be around 4.25, 4.5. Those are the areas that if you'll get confirmation for what you're trying to do. So if the major averages take out the June lows, I'm talking about stocks now. Okay, then you're going to get confirmation that we're going lower. But if you watch these ETF bonds break support, they break support, stocks are going to go lower. If the June low holds on the stock market and the bonds start to go sideways at that point, then maybe you'll be setting yourself up for a rally. I don't think we're going to have that rally. I think we're going to break at least down to that, like I said, on the 95 on that IEF. That's the one I'm really watching. I think that will let us know if we're going to have where we might be able to see a bottom. So right now, look for confirmation of what the market's going to do in those two bond ETFs, and that's just going to you don't want to front run anything or hear what somebody else is saying. Those things aren't holding support, then the market's going lower, and you don't want to try to pick up a bounce. Even if stocks can bounce, if those ETF bond funds go below those support levels, stocks are going to come down with them also. So keep watching both sides there, and that should set you up for when you may want to start to add some positions. But we'll see what Chairman Powell says tomorrow about 2:30 to 3, and see what's going to happen here over the next month. But I'm sitting on the sidelines. I hope you have lots of cash, and I don't think you want to front run anything. You're going to have guys front run them. You're going to have a volatile day tomorrow, but you don't want to be trying to buy buy the bounces and sell offs tomorrow. Just be cautious here and let things work out.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer in the next Tuesday Tech Talk, you can email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.